Cool. Hey, everyone. I'm Arianne Flemming. I'm CEO of Informal Systems, and you've seen a lot of my colleagues speak earlier today. Informal's a core development contributor to the Cosmos network, focused on supporting and building a correct and secure multi-chain internet of blockchains. And at Informal, I focus on the non-technical aspects of our work. I've played various roles in organizations supporting the Cosmos network for the past 3 years. And today, I'm not going to discuss the specific work of Informal or our role in Cosmos. As I mentioned, I've had many colleagues who discussed these topics throughout this amazing day, and Jarko's Star Wars rendition will be hard to beat. So instead, I'm going to discuss how the nature of the blockchain industry is changing the game of managing companies, and how we must think about company management in terms of sustainability to bridge the old world of centralized systems and the new world of coordination, autonomy, and incentive alignment. Building a business is hard. If you take guidance from any traditional startup mantra, it'll tell you you must work with good people, don't run out of money, and build something customers want. This all works well and fine in the old definition of traditional YC-like startups, where founders are working together in their basement, staying tight on finances, quickly iterating on an MVP, trying to raise money, and constantly chasing MRR to prove out product market fit. But this old model doesn't hold so easily when we start talking about building public goods like blockchains. Zaki Manyan gave a great talk at the MIT Bitcoin Expo back in 2019 on defining an MVP for the next generation of blockchains, highlighting how the product development cycle for traditional startups isn't on the same timescale as building public blockchain infrastructure. However, the notion of getting users and feedback as quickly as possible still stands as important. We don't need to ship the pièce de résistance only to find out no one wants to use it. You have to reconcile the tension between building public infrastructure and lean startup principles. And while we fund blockchain development like infrastructure, the irony of the companies and people building these large-scale public infrastructures is that at the end of the day, they're startups whose biggest risks are not technical, they're operational. Teams that are figuring out effective ways of working together to ship software that can be validated in the market. However, while they may structurally be startups, they can't always operate like startups. All types of companies in this industry, from those building public goods to those building solution-specific applications, must operate more like multinational organizations that have global risk profiles and coordination concerns. We have to reconcile the tension between complex company operations and lean startup principles in an industry where the technology is advancing ahead of company development. Ultimately, the nature of the blockchain industry is not only changing the nature of achieving product market fit and building something customers want, but the process of managing the companies that are doing this product development work has changed completely and changed the rules of the game for company operations. While the technology is unlocking new kinds of potential we've never seen before, we're still in a transition period, and I expect we will be for quite some time, between the old world of centralized systems and middlemen and the new world of coordination, autonomy, and incentive alignment. And in order to make these revolutionary technologies realize their true potential and make it to market to become the practical, useful technologies that promise to push society forward, we need to manage pragmatism over tribalism and bridge the old world and the new world. In turn, we need to set up company operations with this transition in mind, hedging risk in the old world while taking advantages of opportunity in the new world in order to be sustainable. I'm going to talk about 3 key areas of company operations that the blockchain industry has completely turned on its head. First, hiring, working with good people. Second, social coordination, collaborating effectively as a team to build something customers want. And third, finance, don't run out of money. So first, I'm going to dive into hiring. As you all know and can tell from all of the speakers from all over the world today, this industry is global in nature. More so than any other field in tech, the blockchain ecosystem has an unprecedented amount of remote and globally distributed teams. It's a truly global movement of passionate crusaders working on hard problems together in a distributed and remote fashion. These teams are more global than ever, and hiring good people in your startup doesn't just mean finding people in your city that you love to work with. It often means collaborating with people who were once strangers on the internet, because the industry has brought together people where passion overrides proximity. So how has the global nature of this industry impacted company operations? There is an inherent tension between the old world of hiring based on traditional country-specific employment law rules and regulations and a global movement of people working together around the world. And while the teams building these blockchain technologies ideologically want to work without barriers, we're still bound in many ways by the old system. We don't have global passports, and we have to compromise and operate within existing structures. So for the founders out there, have you ever had a painful contract negotiation experience with a candidate where a candidate challenges everything, they want every line of your contract changed, you have to call your lawyer, you go back and forth a few times to discuss the changes, and now you can imagine the candidate you're hiring is in a foreign country, and their employment law rules say that the contract has to be in 2 languages. And so you hired a local lawyer, but you don't speak the same language as them. And so you don't really know if you fully understand the implications of what they're recommending. So now increase that confusion by 10 if you want to hire in 10 countries. The surface area of risk when hiring globally grows exponentially. Not only is it hard enough for startups to keep up with one country, but these blockchain startups that hire globally now have to keep up with many. Hiring isn't just pulling a template employment contract from a startup agreement off the internet, because now your employees are in countries all over the world. The company you founded to build technology needs to be registered in a country to do business or hire. You may need a legal entity in a new location to hire there. You need to understand the labor laws and tax implications in each country. As many companies do, you could just hire everyone as contractors, but that could be exposing your small startup to an unknown amount of risk and doesn't always look out for the best interests of employees, especially those who have families or aging parents where local insurance and employment benefits are important to them. So how can startups operating globally hire while hedging this risk? There are some solutions that exist to hiring globally today, like global employment outsourcing agencies that can act as an employer of record, but these solutions can be costly. You lose operational control, you lose the ability to take advantage of local grants and government financing opportunities, and ultimately were created for much larger organizations. I've worked with a number of company structures that include subsidiaries in Canada and the US and all over Europe, and after years and expensive legal fees, we've essentially created a business-in-a-box company structure that allows you to set up a hub-and-spoke model by setting up a North American parent company with wholly owned subsidiaries in Europe and a cost-plus service agreement that's transfer pricing compliant that allows you to fund these entities. Transfer pricing isn't something that most startups even have to think about, and yet these global blockchain companies are getting an introduction to complex global accounting at a very early age. This model makes understanding the risk profile more manageable and bounded, and I'll talk more on hubs later, but ultimately, in order to be sustainable and be able to work with great people, we have to learn to operate reasonably within existing paradigms in order to hedge our risk. Social coordination. In this industry, building something customers want is often no longer the focus of a singular entity, but becomes the coordinated effort of many organizations working towards common goals. In Cosmos alone, we have 7 companies coordinating to make IBC come to life. As with the development and life cycle with open source projects created and brought together by passionate developers all over the world, which then over time becomes the responsibility of individual companies to manage, the development of various aspects of blockchain infrastructure for many projects are becoming the responsibility of many distributed companies. Coordinating with people and organizations worldwide is not an easy feat. Have you ever run out of hours in the day to have meetings because suddenly it's nighttime in Europe and you couldn't cram enough morning meetings in before noon on the East Coast or before 9 a.m. on the West Coast? If you're working with a global team, you better be a morning person on the West Coast and a night owl in Europe, or up at all hours in Asia. As we balance the old world of everyone working together in an office to the new world of global coordination, we face complex HR and process-oriented issues that startups generally don't have to deal with early on in their life cycle. Management and human resource attention suddenly became much more important and complex than it might at a traditional 15-person company where everyone sees each other every day at the office. The coordination challenges for startups operating in a global environment have become amplified to be more like a large organization. So what can these distributed and remote companies do to help combat these challenges? Clear ownership and responsibility is key, meeting regularly to ensure proactive connection efforts are made to build trust and cohesion, actively managing the goals of individuals on a team. Another solution that's been successful in my experience, not only for hiring, but for supporting distributed teams, is creating hubs where people can go when they want and are able to in COVID-free times, so that you're remote first, but not remote only, meaning you provide the freedom and flexibility for anyone to feel empowered to work remotely when they want, while also providing the space for in-person interactions. This really allows for the best of both worlds, valuable in-person interaction time while having the freedom, flexibility, and focus that a remote environment provides. This model makes operating a global business easier while also fostering trust and cohesion within groups. The distributed nature of this industry is truly wonderful. It opens many doors, it brings together people from all over the globe to passionately work on hard problems together, and forces people to coordinate and build trust in new ways in our changing world. But as we bridge the old world of borders and boundaries and move towards a world of working with people all over the globe, it isn't a straightforward path to get there, and the intermediate path can come with trade-offs. It means what would traditionally be straightforward operations has now forced these startups to act more like multinational companies with international offices, employees, payroll, taxes, risk profiles, employment laws, and internal coordination processes. Social coordination has changed and adapted, and while the blockchain industry has been in a perfect position to deal with the COVID-19 pandemic from a remote work perspective, there is a non-negligible cost to having remote work and the risk and complexities involved that these startups must address in order to be competitive and sustainable in the long run, and in order to bring these revolutionary technologies to play. Part 3, finance. So the CFO of a Silicon Valley Series A or B funded startup is focused on financial planning and constantly monitoring cash to make sure there's enough runway to make it to the next round of financing. They might be working with outside firms on accounting and end-of-month closes, making sure customers are paying on time, and more. There's lots of moving parts, but at least they're speaking a common language. They're getting paid in dollars and paying out in dollars. Now imagine you're not getting paid in dollars anymore, but you're taking payment for product or services in tokens. And some of these tokens may be liquid and some not liquid, but you're still living in a world where you have to pay bills in dollars. Blockchain startups are playing a different game, managing the mantra of don't run out of cash. As startups from dev shops to exchanges to wallets to validators to companies building all kinds of decentralized applications are often taking payment in tokens. In order to bridge the operations of the world where expenses are paid in fiat and the token universe where we accept payments in tokens, we need to think about treasury management. Ultimately, treasury management just exploded in complexity compared to what our CFO at the Series A or B startup had to deal with. These token holdings introduce a whole new element of treasury management that many founders, particularly technical founders, never had to consider. There's a new level of both currency and liquidity risk to manage that traditional small startups don't generally face until they're much larger organizations. An expanded balance sheet of cash and tokens presents a huge opportunity for companies to grow their treasury and autonomously manage their wealth if balanced well. But many technical startup founders didn't sign up to manage a token fund. Traditional advice follows that cash is queen, and these startups are no longer thinking just about cash. They're thinking about an entire balance sheet of tokens alongside cash. Their startup operations are no longer about making sure they have enough cash on hand in their checking account, but now you need to balance your token holdings while making sure you keep enough liquid cash on hand to be paying salaries, lawyer, rent, and taxes, which in particular can create large risk exposure for companies who receive revenue in non-cash assets. Instead of a traditional balance sheet with some assets of cash and computer equipment, We've transformed the balance sheets to now be very highly complex with lots of variables and things to consider at all times. Cash flow management, crypto FX management, and long-term investments have now all come into play. We're seeing many traditional hedge funds and public firms expanding their asset management to include crypto on their balance sheet and holding Bitcoin as a store of value and hedge against inflation. These companies also have lots of finance folks on staff to help secure and monitor this. And small companies focused on building don't have such luxuries. Founders and early employees now need to decide for themselves how to manage their treasury. Do they take active positions? Do they speculate? Do they trade? These startups have just moved from operating their business to becoming investors in a fund. If you manage the fund well, balance long-term strategic vision with short-term liquidity, then for these startups, revenue may become irrelevant. In the new world, you're not a startup. You're a fund that may never need outside capital, unlocking new opportunities for startup founders who would traditionally have to spend sometimes 50% of their time fundraising to now being able to autonomously focus on their business. The highly publicized MicroStrategy expanded their balance sheet by purchasing over 38,000 Bitcoin for an average price of around 11,000 per BTC. And as of last week, that number's over 40,000 now. So that's equal to over $740 million, and that's an increase in over $300 million since Q3. For context, MicroStrategy's earned about $78 million in net income from the last 3.5 years from their business operations as an enterprise business analytics and mobility platform, effectively meaning that whatever product or service they offer becomes irrelevant to the value of their company given their Bitcoin holdings. This idea that the value of your business is not your core business is not unheard of. Saks Fifth Avenue wasn't bought as a clothing store, but as a real estate company with billions of dollars in asset value and far less in revenue. As fundraisers and ICOs remove the need for organizations to raise money from venture capitalists, holding tokens may change the nature of services businesses from operating at a consistent 25% margin to now having a well-managed portfolio that allows for a very long runway. For companies holding a balance sheet of diverse assets, they must determine their asset management strategy. It could be conservative and passively hedged to manage cash. It could be aggressive and actively targeting returns, more like a hedge fund. It could be something in between. But regardless of the strategy, hedging is essential to bridge the world of fiat expenses and token revenue, because lack of hedging to fiat can cause serious liquidity strains and a resulting inability to meet fiat obligations, forcing projects to liquidate at historical lows. And even if you were able to pay all of your expenses in tokens, taxes in particular can create a huge liability, as most governments won't accept tax payments in crypto, forcing projects to liquidate token holdings and constantly be thinking about tax planning. So how can these startup mini funds think about hedging? Some options: you could choose to passively hedge to sell crypto preemptively to meet your fiat obligations. You could take a more active approach of only selling the gains and buying the dips in order to rebalance your portfolio based on percentage allocations. You could take advantage of the derivatives markets in order to achieve above market return on your assets. In time, smart contract automation can help manage liquidity for organizations by creating an autonomous buy-sell treasury function. At Informal, we take somewhat of an index approach where we rebalance our portfolio based on targets percentage allocations, based on our token and cash holdings with a minimum cash floor. But overall, for these emerging startup mini funds, I think it's important not to get too complicated, but don't take anything for granted either. We need to set strategies and stick to them in order to manage our cash while keeping sight of the potential upside, so that in the crypto winters, we'll be able to survive. As we move towards the new world of crypto becoming more integrated in society, we're entering a new era of business operations, where we're moving from operating to operating and investing. Maybe one day tax regulation in North America will allow us to transact in crypto without having a disposition on every transaction and making it a more viable solution for ongoing payments. And if not, we can all leave and go move to crypto-friendly Portugal. And perhaps more of these complex corporate entities will no longer exist, and DAOs will become a more widespread solution. But the reality for many right now is that we straddle two worlds and are in a transition period where we need to learn to operate these new types of businesses before we think about automating them away. As companies holding tokens becomes more mainstream, there will need to be more support for running these complex organizations. Just as there's 10 million SaaS tools to help startups run their businesses, I think there's a massive opportunity for tools and businesses to support this next generation of startups. We're starting to see this support, and I expect to see much more in terms of tax tracking and accounting tools to help track crypto assets without manual intervention, contract templates and tools that are streamlined for global businesses, asset management dashboards and alerts to help you stay on top of your finances, and more asset managers and portfolio advisors for large and small companies to help companies manage their treasury and trading strategies. In this industry, while we may functionally be startups coordinating to build software and validate it in the market, we're operationally not running startups anymore, but building multinational businesses that are far more complex than we could have anticipated. And we must acknowledge and adapt to this operational risk. We're in a transition period where, in order to be sustainable, we must bridge the gap between real-world operations functions and a new world of company management. And that means being smart about cash and understanding and complying with the rules and regulations of traditional systems. And while the technology wants to operate without bounds, we in the real world must play within the traditional systems in order to hedge our risk. As Nicholas Taleb once said, to sleep well, hedge all your tail exposures. Be open and hide nothing from your enemies. Pay all your taxes, as unpaid taxes are the mother of all tail risk. Be uncancelable, back up your data, and have some gold or Bitcoin. If we play our cards right, I think we'll do just fine. And if you have questions, please reach out to me at Informal for everything that we've learned along the way. Thanks, guys. Cool. Are there any, I think there's a few questions here. Okay, what do you think would be a step towards making crypto easier to interact with day to day? I think there are a few things, like some small policy changes that would make it more reasonable to interact with. Most countries classify crypto as property, and as such, there's a capital gain or loss every time you make a transaction, no matter how big or small it is. But some countries in Europe, for example, have allowed what's called a de minimis exemption, meaning like transactions under a certain amount, say I think it's $800 or so, there's no need to calculate a gain or loss, meaning it's easier to use in small transactions and it's less overhead to manage it compliantly. From a policy perspective, I'll also pitch that Ethan Buckman really wants to see capital gains exemptions on charitable donations in crypto, which is the case for securities like stocks, but not yet the case for crypto, at least in Canada. So that could be another cool policy change coming down the pipeline. Cool. How has a massive influx of capital into the space changed how we do operations? Have incentives changed compared to traditional Series A or B startups? This is actually, I think it's a really interesting point about incentive changes and capital influxes, because I think, as I said, you have to manage kind of these complex company operations and acting much more like a large organization with lean startup principles. So, with money comes power, and you have to ensure that, you don't get lazy in the meantime. So I think it's definitely like ensuring that we still live by some of these lean startup principles while having the benefit of having these long runways and a very diversified portfolio is like pretty essential. Cool. Any other questions? Oh, I see another couple. Where do you find professionals to consult on legal and accounting that cross multiple asset and employment laws and bookkeeping practices? Great question. It doesn't exist, and it's a little bit of, it feels like pasting things together. One of the reasons that I found hubs and like working in specific country hubs to be really practical for company operations is that you're able to kind of streamline your legal and accounting practices to just 2 countries, 2 or 3 or maybe 4, but at least it's a manageable amount. So you can have a lot more certainty on kind of your employment law practices, your accounting practices, and so on. And then it just kind of helps streamline these things a little bit more. Let's see some other questions. As a blockchain crypto startup, what are some things to consider when deciding upon a corporate structure and incorporation? There's definitely lots of things to consider. I think the biggest piece of advice I would give is make sure you work with, try and work with people who have kind of gone through the process before, so they can help guide your decision, because this industry is often us creating our own playbook. It's not predefined. So if you can find someone who has kind of gone through the process and understands it and so on, that can definitely help streamline your execution and your process, and making sure that typically having someone on the ground in the country who speaks that language can be immensely valuable. I know we've found that with I used to work as managing director of the Interchain Foundation, and just having people on the ground in Switzerland was so critical to general operations. So making sure if you can find a location that allows you to have someone there, it can really help streamline things. Are there any other questions? What are different types of incentives you see that work for startups? I guess I can interpret this in a few ways. Oh, there's a few comments on this one. I'll go back to the other question. I guess I can interpret types of incentives in different ways. I think a lot of, well, from my personal experience, I've worked with incentives, both tokens as well as equity, and both things work in various ways. I think it's definitely valuable for startups who are working in this space to incentivize their employees with tokens, because it's a direct line into what they're building, and it's not some hypothetical future stock which may or may not be valuable at some point in time. So it's really nice to, if you can, be able to incentivize your team with that, even if it's small amounts, just to give them that ownership. I think that's one of the real downfalls of the Silicon Valley, options dream, is it promises you a future dream which may never come to reality, and you still have to pay for it. So I think tokens is a really nice way to incentivize your employees if you can. It is complicated, and dealing with the taxes and whatnot can be a pain, but if you can figure it out, it's worth it. Also, there was one more comment on where do you find legal professionals also that service nonprofit worker co-ops. So this goes back to a previous question about where do you find professionals to consult legal and accounting and also service nonprofit worker co-ops. So I will quickly say that Informal Systems is actually structured like a workers' cooperative. We are not a workers' cooperative. We are not a statutory workers' cooperative. We are structured like a workers' cooperative because we found that creating a actual statutory co-op was far too much administrative overhead for us to manage. So as such, we simulated a co-op through a traditional corporate structure. So Informal has a one member, one vote democratic control of important decisions. So employees vote on the board of directors, and the board of directors elects the officers of the corporation. So in terms of one of the reasons that we chose not to go the path of a traditional statutory co-op was to minimize, not only minimize the overhead, but actually be able to get advice on how to structure the company. There's very few lawyers or accountants in Canada that actually know how co-op law works. So instead, we kind of just accepted that and worked with traditional lawyers to simulate what we wanted rather than trying to accommodate in something that was too complex. So awesome. I think that's all the questions, and I think that is time. So thank you everyone for joining, and I hope the rest of everyone enjoys the rest of the conference.